This episode of the Fire Dog Podcast is supported by Roll Call Coins. Founded by a 24-year Air Force firefighter veteran, they understand that a coin represents more than just an event. It represents a story. Using 3D modeling and custom textures, Roll Call has moved beyond generic designs to create premium, standout coins. Whether you're honoring a department or branding a business, they make the process effortless. Start your design today at rollcallcoins.com and let your coin stand out in the stack. This episode of the Fire Dog Podcast is supported by AOS Services, the one-stop shop for firefighting equipment compliance built for the DoD. At AOS Services, they help military fire departments stay mission-ready with customized programs that bundle everything from SCBAs and compressors to hoses, ladders, PPE care, rescue gear, and more. Their teams work worldwide, so whether you're stateside or overseas, they've got you covered. For all your firefighting equipment compliance needs, visit aosservicesinc.com to learn more.
This is the Fire Dog Podcast.
The views and opinions presented on today's episode are those of the speaker and do not necessarily represent the views of the Department of Defense or the United States Air Force.
Welcome, my name is Matt Wilson, and thank you for listening to episode 63 of the Fire Dog Podcast. In today's episode, we're going to hear from former Air Force firefighter and current tax specialist, Matt Stelmaszek. Matt went to Indiana University and spent 4 years active duty, eventually separating from the service at Nellis Air Force Base. He's now building his own tax practice with a specialty in tax planning for federal firefighters. The episode is a little bit of a curveball from our normal programming, but the tax filing deadline is approaching. We wanted to put out something practical that helps firefighters understand the unique planning points that apply to them this tax season. It is my pleasure to welcome to the podcast, Matt Stelmaszek.
All right. So a little bit of a curveball from our normal programming here, bringing on a former firefighter, current tax specialist, and a pretty timely episode being tax season. And the 2025 tax year is a unique year with tons of planning points that are applicable to firefighters. And so, Matt, we're glad to have you on. Will you give us a little bit about yourself, your background in the Air Force, and now your transition to civilian life?
Yeah, Chris, Matt, thanks for having me on. I'm excited to talk tax. Not everyone, every day asks you to talk about tax, so this is exciting for me. I was an Air Force firefighter at Aviano when I joined in 2021. And then we PCSed to Nellis, and then I separated from Nellis in the winter of 24. I came back as a civilian onto Nellis, and then my wife's active duty, so we were going to leave anyway. And so when they offered the DRP and they're like, hey, we'll pay you for 6 months to not work, I got Chief Thompson's blessing to do that. And so I took that, and that's when I started really transitioning into a big tax practice.
And so now you're working on a master's degree in tax using your GI Bill. Was that something you'd started while you were in the Air Force?
No, I did the chartered financial consultant through American College while I was in. And then once I separated, I decided, like, this benefit, I didn't stay in long enough to transfer it. So it was either use it or lose it for me. And so I just decided that the master's in tax at Penn State would line up with my career goals and ultimately what I wanted to do with my own tax practice.
Awesome. Actually, that's a great shout out for the American College of Financial Services. Any nerds out there listening? I also got to benefit from their veteran scholarship and do a master's degree in finance and the certified financial planner coursework, full ride. So a phenomenal program for anybody that's thinking about, getting into finance or tax or anything like that when they get out of the military. So you recently passed the 3 enrolled agent exams. Will you tell us a little bit about what that means?
Yeah, so an enrolled agent is it's recognized by the IRS. It's the only certification that's nationally recognized, and so it's 3 exams. They broken in 3 different parts. So one's on individual tax, one's on business, and then one is on policy and procedure. So enrolled agents have unlimited representation rights before the IRS. So you open your mail and you get a letter from the IRS and says, hey, we want to look at, tax year 22 or, whatever tax year, or hey, you have an outstanding tax liability. An enrolled agent has unlimited representation rights and they can represent you before the IRS. And so the only two other people who have unlimited representation rights are CPAs and attorneys.
Got it. Okay. And so now you've started Stellar Wealth Management, where you specialize in tax planning for military, and then I guess everything that's kind of military adjacent, right? From military landlords to federal firefighters. We talk a little bit about your specialty.
Yeah, so it's kind of like you said, anything that kind of starts with military and goes from those branches. So for the military folks, like they tend to have complicated state tax returns, especially for spouses. What qualifies as income? What do you need to claim? Am I paying state income tax? Am I not? So as far as like the military specific, that's the big one. And then a lot of military turn out to be landlords. Like you bought a house, you used your VA loan, you want to do the house hacking. And so now you have or a property in another state. You have tenants, you have income. How do you claim it? How do you claim it correctly? So that is another big piece. We did that. We're looking to buy our fourth house. So we have tenants in different states. Like I understand how complicated it gets. And then Fed fire. So there's, for a brief time, I was a federal firefighter, worked with a lot of them. And so there's a lot of tax, especially this year, like you mentioned in the intro. The 2025 is a very unique tax year. So it worked well with my practice and then all of the new changes in tax law.
Awesome. Well, before we get into some of those planning points for 2025, first, I know we always have to say nothing in this episode should be considered tax, legal, or investment advice, right? These are some big picture best practices that apply to a lot of people. But if anybody has questions about, your specific tax return, your family's finances, you should reach out to your financial advisor, your tax advisor. Secondly, before we get into those planning points, will you talk just a little bit about how our tax system actually works?
Yeah, so we have a progressive tax system in the U.S., and what that means is the more that you make, the more you will pay. And so while that's true with a flat tax system, we have different brackets. And so as you work your way up through those brackets, you will pay more. So I think the biggest confusing point is when someone says, hey, I got all this overtime, I made more money, I don't want to be pushed into a higher tax bracket. And so it's not that if you were pushed into a higher bracket, that affects all of your income. You have to work your way through, and only the next dollar is taxed at that rate. So here's some just easy numbers, and these are not real tax brackets. But let's say you made $250 this year, and the 10% tax bracket was 0 to 100. If you paid 10% on that, you would pay $10. If the next tax bracket was $100 to $200, and it was 15%, you would pay $15. And then if you made that $50 in over 200, let's say that tax bracket is 20%, well, you would pay $10 on that 50. So even though you're in this scenario, let's say the 20% tax bracket, you are not paying 20% on all of that income. That amounts to $35 total. And if you divide that by the 250 that you made, it's a 14% effective rate. So that's a good illustration of your marginal rate would be the highest rate that your last dollar is taxed at. In this, again, totally fictional scenario, that's 20%. So your marginal rate would be 20%. Your effective rate, which is how much you paid in tax versus how much you made, again, in this scenario is 14%. So your effective rate is going to be lower than your marginal rate. And that's because you work your way through those brackets. Does that clarify the progressive tax system?
Yeah, so that's a kind of a common misconception, right? That there are like tax cliffs where if you earn just a little too much overtime or whatever it might be, that now all your income is bumped into the next tax bracket. But that's not true at all. It's just if it's $1 into the next tax bracket, it's just that $1 being taxed at the higher rate.
Yeah, and I got a lot of questions.
And so we hear about.
Sorry.
No, go ahead.
I was gonna say I get a lot of questions when after the shutdown, because some people were like, "I'm gonna get this huge paycheck, like I'm gonna get taxed like crazy," and you're taxed at the same rate. It's not that this paycheck is bigger, you're gonna pay more in tax. It's just that it's all at once versus spread out over a month and a half. So another just like misconception that because you made a lot of money in one month or whatever, that somehow it's gonna dramatically affect your taxes, and it doesn't.
Got it. And so when we hear about tax deductions and tax credits, how's that play into the tax system? What's the difference there?
So a tax deduction is only it's only equal to your tax bracket that it falls in. So if you are in the 22% tax bracket and you have a $20,000 deduction, if you take 22% of that 20,000, that's your benefit. So it's significantly smaller. A tax credit is a dollar for dollar amount that we are saying you paid in tax. So the most common one that our listeners are probably going to have is the child tax credit. And so if you had a $3,000 tax liability and you got a $2,000 child tax credit, it is essentially as if you paid $2,000 of tax.
Got it. So tax deductions are good. Tax credits are generally more good.
If you had the option, a credit is definitely, because it takes just a lot more money for a deduction to get you the same benefit. So like some of these overtimes deductions you're seeing that are $15,000, $18,000. And again, these numbers, they start out really big because an $18,000 deduction means that you worked a lot of overtime, and you have like a $40,000, $50,000 overtime amount you were paid. You get a third of that. That gets smaller. Then you take the deduction times your tax rate, and that gets smaller. So is it a benefit? Absolutely. Is it the gigantic benefit that maybe we thought it was? No. But it's still obviously worth claiming. Like no one, you don't have a patriotic duty to pay more in tax than required.
That's right. Yeah. Tax avoidance is good. That's a big difference than tax evasion. Tax avoidance is something everybody should take advantage of, whatever rules apply to them. And I'm sure one you're hearing a lot about right now is this no tax on overtime tax deduction. What's that look like?
So this is one of the new tax laws for 2025. It's again started out as kind of this big where it said, hey, we're not going to tax tips, we're not going to tax overtime. And when it got passed through Congress, there was some stipulations that were applied to it, and then so we'll walk through those. And the first is that it needs to be FLSA, the Fair Labor Standard Act. It needs to be mandated by FLSA. So the example I always use is if you were a nurse and you worked in a hospital and you worked a holiday and they paid you double time. It's very generous for the hospital, but it's not required by FLSA. Therefore, it's not deductible. Now, for our federal firefighters, you work whatever your schedule is, you have some overtime that's built in. They pay you a premium for that overtime. They don't do it out of their kindness of their heart. They do it because it's mandated from FLSA. So in that regard, it should be deductible.
Got it. And so we're talking strictly about civilian federal firefighters here, where an enlisted firefighter, it doesn't really matter how many hours you work, right?
No, the Air Force or Army, whoever you're, they own you. You can't you don't get any deduction. You're paid what you're paid. Your largest benefit is going to be your tax-free, your BAH, your BAS, and anything else you get. You have access to other tax benefits, if you're deployed and you can put it in your savings, your SDP. Like, there are other tax benefits for our active duty folks, but as far as the overtime, like, you don't get anything for being active duty and working 144 hours a week or a pay period.
Got it. But for all the military members who are married to somebody that's in a civilian job that might work overtime, obviously a big planning point for this year, or any again, the federal firefighter, civilians, maybe you're a guard or reservist who works on the civilian side. I know 2025 is kind of unique because your qualified overtime, or the premium portion is the language that you're seeing used. The half part of time and a half may or may not be reported for you. And so what are you seeing, specifically on the federal firefighter side? What needs to happen to ensure a federal firefighter gets the full tax deduction that they're entitled to this year?
So there's this, and this, it sounds simple, and it gets really complicated because of the law and because of how things happened in 2025. So like you said, it's qualified overtime. And so it is the premium portion, the half of time and half, like you said. I think what DFAS did was, if you look at an LES, like a federal firefighter LES, you will see two things. You'll see OT in tour and you'll see overtime. I think what DFAS did was, however they were going to report overtime, they said, okay, anything that's logged as overtime, we will take 1/3 of that and put it in your December LES on the bottom. Because what I've seen is the firefighters who work, extra shifts and they get paid their overtime, that number on the bottom of their December LES that says, hey, this is your qualified overtime, that number is perfect to 1/3 of the overtime that they worked for the overtime shifts they picked up. It's perfect. It's 1/3. It's exactly what the law says. I think the issue is they didn't realize that federal firefighters work. And again, I'm going on a 48-48 schedule, so 144 hours of pay period, that they work 38 hours of overtime, OT in tour, and that's what it says on the LAS, OT in tour. They didn't see that and say, hey, we need to calculate this. Now, the IRS has said for 2025, it is optional for the employer to report it. So they don't have to report it. I think they're reporting it incorrectly because they only chose the overtime and not the OT and tour. Now, I'm going to stop there and say, aside from their reporting for federal firefighters, I've seen nurses, right, spouses of federal firefighters who are nurses, and sometimes they report it and sometimes they don't. And it's up to the taxpayer this year for 2025 to calculate it.
Yeah, so it would be really easy for the firefighter that gives their CPA, or maybe they use some sort of DIY tax prep software, TurboTax, to enter the wrong amount or not be prompted to enter anything at all if they don't know that they've got to go back and do their own calculation, find out actually how much qualified overtime they worked, right?
Yeah, so for 2025, since it's still on the taxpayer, what I've recommended that my clients do is get every pay stub you can, because it's hard to remember what you did in January of 25 in February of 26, especially, hey, you had a run that went long and you got your 2-hour minimum of overtime, because you stayed beyond roll call. Those things tend to, we tend to forget. And so you can only get 12 months of pay stubs from my pay. So for the time, like for the clients who are back in January of 2025 trying to figure out, if they worked overtime or not, I've been telling them to go to whatever their reporting is. So like ATAPs for Air Force, and look at see, hey, was this reported? Did I work overtime? as far as 26, in 2026, it's supposed to be reported on the W-2. I don't know how it's going to be reported. I don't know if it's going to be corrected. So I would recommend that starting now for 26, you start saving all of your pay stubs. So come tax season in 27, you can have every pay stub and you're not trying to backtrack and log into ATABs and figure out whether or not, you're working overtime this here. I don't know what the DIY software is going to do. I don't know what the professional software is going to do. There's a lot of things in my software that I can override just because I know it's incorrect. I don't know what the DIY software will allow you to do in 26, but it is all supposed to be reported. And I hope that DFAS figures out that, hey, this OT in tour qualifies. And let me tell you the reason, my opinion, and I would defend this before the IRS. The reason they included the overtime on the bottom of your LES in December is because it is required by FLSA. It is the same requirement that you get OT in tour. It is required by FLSA 207 Section K. So I've gotten a lot of questions of, hey, I'm taking comp time when I work my overtime. Hey, I didn't use my comp time. I got paid out my comp time at the end of the year. Just a lot of questions about what is actually qualified overtime. And the two things that you need to look at is, were you paid a premium and why were you paid a premium? So the comp time example, I work an overtime shift. I work 24 hours extra. The next pay period, I want to take the first day off. My kid's got something. I want to be at home. When that's reported on your LES, you're going to see that comp time taken and you weren't paid a premium. And that's an easy, okay, well, I wasn't paid a premium, so it's not deductible. If you were paid a premium, why were you paid a premium? So there's an example they used in IRS Notice 2025-69, and it was relevant to, I believe, a law enforcement officer under 207 Section O, because it was, you had the option. Do you want cash or do you want overtime pay? It was like one of those, and it was totally not applicable to what we do. And then people start, oh, well, the comp time in this scenario that the IRS said, so I don't know if I can take my comp. It was not applicable. Federal firefighters are under 207K, not 207O or any of the other ones. So it's important to look at why you were paid a premium and if you were paid a premium. Those are the two things you need to know.
So the obviously the big takeaway here is, don't assume your tax documents are going to get you the proper overtime deduction. It's part of the value of working with somebody like Matt, who understands this stuff. But I've seen it commonly on the civilian side as well, where maybe it's not reported at all on the W-2, and you got to reference your pay stub if you're going to get it, or the wrong thing is reported on the W-2. So even a firefighter that works the normal 24 on, 48 off schedule, there's similar in-tour overtime that you technically receive, in FLSA required premium for, and it's not showing up on a lot of W-2s. So that's something you have to dig into yourself for 2025, and hopefully employers will figure it out for 2026, but it's complicated. So I could easily see the number being reported for this year being wrong just because of the unique rules that apply to firefighters. So lots of things coming up that have an April 15th deadline. Things that firefighters can do for last year all the way up until the tax filing deadline. Will you talk to us about some of the different deadlines that are coming up?
So April 15th is the tax day deadline. So it's the deadline. This is also a misconception. It's the deadline to file. So if you file an extension and you push it to October 15th, that's fine. You can file October 15th. You still have to pay by April 15th. So it is not an extension to pay. It's an extension to file. So if you are expecting to owe, that money is due, or you will be charged interest and a penalty. Just so we know what the April 15th deadline is. The other thing you can do is you can still contribute to an IRA. And this is a point that I think gets confused for a lot of people, because I'll ask my client, hey, did you contribute to an IRA? An IRA is an individual retirement arrangement, commonly called an individual retirement account. It is totally separate from your TSP. And some people think, oh yeah, I contributed. It comes out every month on my pay stub. And the difference between an IRA and an employer-sponsored plan is the employer. So if you have a 401k at your job, if you have a 403b or TSP, which is the federal 401k, that is employer-sponsored. You can only do it with payroll deductions, and it is tied to your employer. An IRA is individual. And so these are most commonly going to be at Schwab, Fidelity, Vanguard, right? The big three. So you can contribute. There's a maximum. So for 2025, it was $7,000. You can contribute until April 15th. If you've already filed your taxes, it kind of becomes a headache for your tax preparer, so if you haven't filed, you can still contribute. If you have already filed and you still want to contribute, tell your tax preparer, because there's some things that need to happen. But you have up until April 15th to contribute for 2025, and they make it real easy. If you were, again, Schwab, Fidelity, Vanguard, you go on there and say, hey, I want to contribute $7,000. It'll ask you which year, for 2026 or for 2025. So in theory, you could go in today and contribute $7,000 for 2025. You can contribute $7,500 for 2026 in one day.
And I'm sure people have heard of a traditional IRA versus a Roth IRA. What's the difference there?
So, and again, this is all retirement accounts. You're going to have, there's the account, and then there's the character. And so the character would be traditional or Roth. It's not like a separate, like you don't have a separate Roth TSP and or a separate 401k. It's all one account. It's just that the pie for the characters is broken up differently. And so traditional means it's tax deferred. So we're kicking the tax can down the road. And then today we're going to lower our taxable income. Roth means we are going to pay taxes today. We will not lower our taxable income, but that money will grow tax-free. So the gains, everything will grow tax-free. When you take it out, it does not affect your income. On the traditional side, since you didn't pay tax, all the growth plus whatever you put in will be taxed as ordinary income. And so there are benefits to both, and there are disadvantages to both. And you really, you need to figure out what makes sense for you. And the best way to do that is with the tax professional, with a financial planner, like a CFP, CHFC. Aside from that, I guess, I don't know. Do you want to, TSP introduced Roth conversions this year, which basically means you're going to take traditional money that you already put in there and convert it, which is a topic in and of itself. But the only thing I will say on that is, measure 100 times and do it once. That can be very costly. So just work with your tax professional, work with your financial planner before you make that decision, because you cannot undo that. It's a one-way street.
That's a great point. I imagine everybody with the TSP got those emails recently saying that you can do a Roth conversion now. And like Matt's saying, that's electing to pay the tax on your traditional pre-tax money to convert it over to Roth, where it'll grow tax-free, but that will be added to your income for whatever year you do it in. So if somebody has a $1,000 TSP and decides to convert the entire thing to Roth in 1 year, that's an extra $100,000 that gets added to your income. And might be taxed at a higher tax bracket than is necessary. So that's a great point for anybody that's seen that and thinking about it. It can make a lot of sense, but you should absolutely know what you're doing before you initiate something like that.
Here's a question for you, gentlemen. Can you decide to do a portion of that traditional conversion this year, next year, and could you plan it out over a series of years so you don't take the big hit on your total income and taxable income?
You want to take that one, Matt?
Sure.
This might
Yeah.
be a
So
softball one.
Yeah.
I don't know.
No, that's perfect.
no, it's a good point. And so the TSP has and you can go read their stuff. So that they allow you to do, I mean, it's like 20, I forget the number. It's like 25, 26 conversions in 1 year. But the way their rules are, and so let's say you have the short answer is yes. You can space it out. But what they've done is there's a $500 minimum on each like character of your TSP. So, and they separate it by the one. So if you're BRS, you have a 1% agency match. Then you have the 4%, or sorry, the 1% agency auto, the 4% match, potentially CZTE, and then potentially traditional. And you have to take $500 minimum of each of those, and they go pro rata, which just means proportional. And you have to convert all of it, but you also have to leave $500. So it gets complicated pretty quick. And like if you were to work with a financial planner and you can plan out your retirement and you see, oh, look, here's some dips, right? I have low taxable income in these years. You would kind of decide, hey, I want to max out the top of my 22% bracket. I want to max out the top of my 24% bracket over these 5 years where my income is lower. That way you can, again, the goal is to pay less tax. And so that's what we're trying to accomplish.
Let me ask you this then. Is it advantageous for military to take advantage of that time that they're in the military when they do have a low taxable income? Because as you'd mentioned, BAS, BAH, those type of incomes are not taxable, right? So I have a kind of a low taxable income. Should I take advantage of my time? If you do have traditional money invested in the traditionals.
So,
and that,
and if we're traveling into territory where you're offering financial advice, I don't know I don't know if this is a minefield or not, but I'm just thinking kind of pragmatically for our military listeners.
no, that's a great example. And I think about the years where there might be a combat zone tax exclusion, right? Where maybe you're the military member, your spouse also works. Normally you're in the 22% tax bracket, but you're deployed this year and your income's not going to be taxable. And so your family's in the 12% tax bracket. That would be like a textbook, potential Roth conversion opportunity where normally every day you're paying taxes at 22% for the money you're working for. If you can pay the tax at 12% and convert some pre-tax money to Roth, that might make a lot of sense. I think that's got to be an incredibly common planning point for anybody with the TSP this year.
Here's another, and I feel like I'm going down a rabbit hole with this Roth conversion thing. It seems to me, the fact that it exists and that it's talked about and people are excited about, oh, I get to do a Roth conversion, that it's more advantageous to have everything kind of invested through that Roth process, right? You'd mentioned that there's disadvantages and advantages to both. For the lay firefighter, the federal firefighter, the active duty service member, reserve service member, broadly speaking, I guess, what direction should I point my money if I'm given these two options to invest with traditional or Roth in my TSP?
So I personally think so. All right, so this is a firefighter podcast. So let's tie back to firefighting. Imagine you're at the pump panel and you have only one discharge, and it's the only thing you can turn on. That's it. If you put everything in your traditional, that is what you are doing. Now, if you had some in Roth and some in traditional, now you have options. right? Okay, well, I have a big bill this year. Let's say I want to put a down payment on my second home in Florida. Well, I'm going to take that out of my Roth account because it's not going to increase my taxable income. I can do whatever I want. The other option, and this is my approach, is I want 3 options. I want to have a taxable account, I want a traditional account, and I want a Roth account, because I want to be able to pull those levers whenever I want. If I have a really low income tax year, let's say I'm a single airman and I do deploy, well, there's potential that not only am I in a low tax bracket, I'm in a 0% long-term capital gains. So I can take that money that I put into Apple, that I did on Robinhood, which I wouldn't recommend, but let's call a spade, right? And I can take those gains 100% tax-free. And so there are benefits to a taxable account, there are benefits to a traditional account, and benefits to a Roth account. And so knowing how to pull those levers and when to do it is really the goal of tax planning.
Which is all the more reason to have an advisor such as yourself and Chris to guide you through the complexities of this, because man, it can get complex, and it's dependent on whether you're married, what point you are in your career, how much you're making each year, whether or not it's overtime. So it's complicated, even as you explain it. And I know that you're trying to help me understand it. It's still really tough to understand, but I appreciate you answering that question.
Yeah.
Matt,
well, so
go ahead.
I was just going to say that. So I think it's also important to have the distinction between tax preparation and tax planning. Tax preparation is to correctly identify what you did last year and get it correctly, marked on that tax return. Tax planning is forward-looking, to say, hey, what are we expecting for the next year? What are we expecting for the next 3 years? And what can we do to minimize our taxes? Again, just to have that distinction between tax prep. Like, if you come to me and say, hey, I want to do this, at this point, we're only limited to what we can do and put money in an IRA, right? The things we can do until the April 15th deadline.
So it's kind of on the tax prep side. We're looking at what happened last year, right? Looking through the rear view mirror versus tax planning, looking through the windshield at how do you minimize your lifetime tax bill. And Matt Wilson, to your point earlier about saving pre-tax or Roth, that is absolutely the number one thing I see on the retirement planning side with firefighters or anybody earning a substantial pension, is that they've saved pre-tax almost their whole career. Roth, really became common in the last 10 years, it feels like, in different types of retirement accounts. And so they've got a taxable pension. Maybe they've earned a Social Security benefit that'll be taxable because of their pension. And now all the money they've saved is taxable money. And so a lot of firefighters have no control of how they're taxed in retirement because it's all taxable. And so I love that visual of being on the pump panel and having multiple levers to pull, multiple discharges of different types of money that you can use to do whatever you need done, especially in retirement, because that truly is such a powerful thing.
Yeah. So I think Roth became an option in '94 in TSP. The other reason federal firefighters normally have a larger traditional balance is because when you retire before 59 and a half from federal service, you do not have a 10% penalty on your withdrawals because you're special category for fire. So there are, again, advantages, disadvantages to everything. The big advantage for the traditional and the 401k for federal firefighters is that you don't have a 10% penalty. You unfortunately don't have access to take Roth money out until 59 and a half. And this, again, can really get into the weeds of how IRA contributions come out from Roth accounts. We won't get into it, but those have different. You have different rules on how you take money out of a Roth IRA, which, if you're a federal firefighter, can benefit you. Like we said, having just different options.
I'd like to ask you guys this, because our audience is largely military and there's some civilian federal firefighters out there that are listening, but, as a military member, through my experience, you kind of are overwhelmed with But you're told at the same time there are resources at your disposal to help you make these, to answer these questions. Who should I be looking for as an active duty military or federal firefighter in terms of, you had mentioned tax preparation and tax planning, and then there's retirement planning and financial advising, if those are maybe the same thing in some cases. So where do I invest my money? How do I prepare for retirement? Where should I look for advice, I guess, is my question.
So for active duty, you do have the option to go to, and I think they changed the name, the MNFR, the Military Family, Airman Family Readiness Center. I think it's Military Family Readiness Center now. They have, through
Yeah,
a
I think
company,
you're right
they
with the
have,
Space Force kind of being added in.
yeah, so you can go check them out, and they have people you have access to. I think there's, being in the, let's say, small business owner, the private space, I think there's always going to be demand for us, because the people who work on base work base hours. So you can't, you don't have access to them at holidays, weekends. And I'm a small business owner. I am always working. So if you need something, you can always get a hold of me. But they're a free resource. Aside from that, on the tax side, there's a group called the Military Tax Experts Alliance, MTEA. And that is a group I've met at conferences that I communicate with on different tax topics. All of them are great, and you can see which one fits your personality, which you should always do. Interview a few of them. On the advising side, I would work with a CFP, CHFC. There's a group. Also, there's a new designation called the MQFP, a Military Qualified Financial Planner. It's now recognized by FINRA. Paul Allen is the guy who spearheaded that one, and there's great people in that realm. So MQFP, CFP, those would be what I look for in an advisor. You're going to pay them typically you're going to pay them a flat fee, and you're only paying for advice. You're not paying them, to manage money. Many of them will manage your money, but it's for a flat fee. So I think the biggest thing is doing research, doing interviews, right? Don't just look someone up and go with them. Like, make sure it's a good fit, because you are going to talk to them about like really deep financial problems, potential. Like there's a lot of very personal things that get involved with your financial advisor and your tax preparer. So I would just make sure it's a good fit personally.
I appreciate you answering that. And Chris, I know I'm kind of getting outside of the scope of the episode. I know we're talking taxes, but I just wanted to, hit that target of opportunity, because I know those are probably the questions that are coming up, beyond taxes. Like, gosh, this stuff sounds complicated. Who should I ask to help me? So.
Yeah, man. And to foot stomp what Matt said, the most bases have a personal financial counselor,
PFC.
through Airman Family Readiness. And they have some sort of financial designation or license, where that's such a great starting point that I feel like people don't take advantage of. If you just need to know, am I getting the match in my TSP? Am I contributing enough to get all the free money if you're in the blended retirement system? Or is my TSP invested the way it should be? They can look at it and give you just kind of these basic steps where maybe you don't need a full-blown advisor. You just need a kind of a roadmap to make sure you're doing the right things with your money. They're absolutely an underutilized resource that I highly recommend.
Yeah, from what I remember during my time, it's almost sometimes guys, girls that don't even realize that they're not making any contributions, right? I don't know how it's changed with the blended retirement. And Matt, I'm sure you could provide some insight, because you joined the military in 21 and you got into the blended retirement. But for us legacy guys with the high 3, when I came in, if you weren't contributing to it, you had to go and make a deliberate action in my pay to, make sure you contributed percentages. You could go 5-6 years or a long time without even, making any contributions to your retirement account, which is a huge foul. I don't know if that still exists with the blended retirement.
So every year the blended retirement system will default to 5%. And so you get a 1%. After 2 years, you get a 1% auto that they will contribute regardless of your contributions, and then a 4% match. So it's a total of 5%. total. It used to default to the G fund. It now defaults to a life cycle fund, and a life cycle fund is it's TSP's version of a target date fund. And so say, hey, you came in this year. Based on that, we think you're going to retire in this year, and we're going to slowly move that portfolio from aggressive to more conservative as you move through retirement. And so this is my personal opinion. There's nothing wrong with a life cycle fund. I think after 20 years, it gets very conservative very quickly. But we've definitely moved beyond, hey, you're in the G fund and you're not going to make any money, which was critical for those who were in prior, and that was the default. So
Yeah, that was.
But I think
that was me. 3-4 years of G fund as A1C Wilson, and then somebody was like, "Hey, have you looked into this?" Right? There was like GCSI. I can't remember, and you had to go and allocate percentages to each one of them, and like which one? I don't know what any of this means. Right? It's just a letter. What does that mean to me? So it was important to get advice back then. But that's good to hear that they have the life cycle option. They didn't have that. With the traditional stuff, they didn't have that option. So that's good. So at least guys, even if they have no clue what's going on, something is going into the retirement account.
Yeah, I think there's a lot of people who, they find fault. I think some people just like to complain, but they find fault with TSP. And I mean, could it be better? Sure. But what can't be better? Like, I think for by and large, it serves a great purpose. And I think it does a pretty good job of that. So, but I think a lot of financial advice is like, there's plenty of resources, and there's plenty of bad information out there, but you're really limited to the best financial advisor in the firehouse. Is kind of like, that's where you're going for your advice. And it's whoever's willing to be like, hey, come here, like, we're changing your TSP. You get that NCO that wants to do that. And that's kind of the advice you have until you decide otherwise in your career.
And I appreciate those NCOs, senior NCOs, that take that responsibility on and try to help, because that's what they're trying to do. They're trying to help, but maybe don't just look at the Facebook group that tells you where to put your money, what fund of the TSP. Probably go to the Military Family Readiness Center, and if you don't have the money to be able to pay somebody to advise you, that resource is available to you.
Matt, so kind of moving back to tax specific planning points, are there some other opportunities before April 15th? I know we just covered, IRA contributions can still be made for 2025. What are some other things that are applicable here in the next couple months?
The only thing we forgot to mention, or that I forgot to mention, was a spousal IRA. So this is a spousal IRA is actually not like, it's not a special account. You don't like open a spousal IRA. That's just what it's called. That's just what everyone calls it, but it is just a normal IRA. And what that does is it allows a spouse, let's say a spouse who isn't working and doesn't have earned income, you can contribute to an IRA with your spouse's earned income, provided there's enough. And for our military folks, there absolutely should be. So as long as you have that amount, you can put it into a spousal IRA to the annual max, 2025, $7,000. Sorry, Chris, is there something else?
No. What about, people may have heard of 529s. And I know this will vary state to state. Some states, like Indiana, where I'm at, will allow a 529 contribution until April 15th. Others, it's the end of the calendar year. But what's a 529, and when would that make sense for a firefighter?
So 529 is a college savings plan for a minor. They're unique in that they are operated by the state, and it's again one of those thing that has a lot of nuance, because you don't have to be a resident of the state to open up the account, nor do you have to plan to attend college in that state to open up the account. So you can be in Indiana, open up a Nevada 529, and your kid can go to school in Georgia. It's a weird account, but the biggest benefit would be if your state of residence that has income tax has an account. It has the potential to be triple tax advantaged in that you get a deduction on your state income tax. There's no federal benefit. you get a deduction on your state income for 529 contributions. It grows tax deferred, so no tax on the growth. And then if you take it out for a qualified expense for education, you can take it tax free. So those are that's why we call it triple tax advantage. They're getting better since they were first introduced, and you can now use the amount. I think it's like $12,000 a year for K-12. Like if you needed that expense for, I don't know, whatever school you were paying for, but for room and board, like there's tons of planning opportunities with 529s, especially once your kid's in college, and if they have scholarships using GI Bill, there's definitely some ways to take some tax-free money out of those accounts. But again, they are run by the state, and if you, again, I'm a nerd, I like to read, so I use DoD MWR libraries all the time. If you go through the Morningstar Investor on DoD MWR libraries, you can get a good comparison by 529 by state. As again, a free resource for active duty if you have a DoD ID, the Morningstar Investor through DoD MWR libraries. But the 529 is one of, let's say, 3 accounts that are available for minors. New in 2025 is the Trump account, and so there's some kinks they need to iron out because they didn't put in a provision. So a contribution to a Trump account is a gift of future interest, and so you actually have to file a gift return. They didn't make that exception. They did for 529s. I'm sure it'll get passed, but as it is today, it's just a weird nuance with that one. But if your child was born after December 31st, 2024, then they are depositing $1,000. They're supposed to deposit sometime this summer a free $1,000 that will grow tax-free. So that's a Trump account. There's a 529 account for minors. The other account for minors is a UTMA or UGMA, a Uniform Gift to Minors Act, or a Unified Transfer to Minors account. And those are essentially a taxable account that is the minor's money, but managed by an adult. So if I open up one for, my daughters, I put money in there. It's technically their money. The gift is done, and then I manage it until the age of majority. So it depends on the state. It could be 18, it could be 21. Again, everything has an advantage and a disadvantage. One of the big disadvantages to that is it's theirs. And so at 21 or 18, depending on your state, depending on how much money you put in, your 18-year-old, now has 15, 20 grand. And you're like, I know what I would do with 20 grand at 18. And I don't think it would be good financial decisions.
Actually, that's a perfect segue to the other thing I want to cover is vehicle interest deduction. Another thing that's new, and unfortunately, maybe the most applicable thing for our military audience, everybody that's getting ready to graduate tech school and go buy a brand new Camaro, listen up, because this may apply to you, but you shouldn't do that. You should go buy the 2010 Toyota that's going to last forever and just not pay any interest. But something that's new, vehicle interest deduction.
Yeah, so another new deduction from the one big beautiful bill, and this is vehicle loan interest. So it has to be a new vehicle, so not a new loan, but a new vehicle. So if you take out a new loan on a 2023, it doesn't count. So a new vehicle, a new loan, with the vehicle has to have final assembly in the U.S., and so you have to look up the VIN to see where it was final assembly was complete. But if that's the case, then the interest you paid, that will flow to the new Schedule 1A, which is where the no tax on tips, the no tax on overtime, and then the no tax on vehicle interest, in addition to the extra senior deduction, they all go on Schedule 1A and flow to your 1040. So, but some pretty big nuances. Like I've had some clients who have filled it out like, oh yeah, I got a new loan. Like, well, it's not a new car, so it doesn't count.
Got it. So again, everybody graduating tech school, don't go off base and pay 19% in interest on a new vehicle, because you can deduct it. but that is a new rule. So
But
Hey, Matt,
deduction,
quick follow-up.
it's not
Go
a
ahead, go
credit.
ahead.
So deduction, not a credit. So even if you pay, $16,000 in interest, you're like, well, if you're in the 12% tax bracket, like there's no reason to pay 19% interest to save $100, like.
Matt, I had a question on the 529. So the way I have 529 account for my children, but the way that it was explained to me is that you can use it for yourself for educational needs potentially if, let's just say, your children don't decide not to pursue anything and you're a 60-year-old with kids out of the house and have this money. Is that true?
So it would depend, I think, on the age gap because I think the generation gap is still pretty big. It should be possible. Most people won't open them up for themselves because there's no growth. Like if you need to pay for college because you wanted to go back to college, like putting money in to just take it out, there's no growth. So there's no benefit to open up a 529 account for yourself. If it's your kids' money and they're not going to use it, you do have the option to roll it into a Roth IRA up to $35,000. It's capped at the annual limit. So for 2026, 7,500, you could do 35,000 total and put it into a Roth IRA and still, kick that. Well, we not kick that tax can down the road. We roll it over to a Roth, and now we're going to forego any tax liability. But it would depend on your age and your kid's age. But you should be able to, yes. So talk to your tax person. Talk to your financial advisor.
Yeah, that's the footnote for every single point made, right?
Yeah.
Yeah, go to the professional, ask them. You guys are professionals, of course, but you need to go out and hire your own if you want to get this kind of advice. But I figured I'd take the opportunity, take advantage of the time with you guys. Chris, did you have any other questions? I'm sorry.
Man, I was going to chime in on the 529. Something that I see get missed a lot is people will pay for private school or for college and just write a check to the institution. Where in Indiana, it's a pretty big benefit where you get a tax credit. It's 20% on up to $7,500. So that's a $1,500 tax credit you could get in any year by contributing to a 529. Again, every state's different, but for somebody that's paying for private school, if you can plop it in the 529 and send it to the school the very next day, you don't get the benefit of the growth like Matt said, but you do get that state tax credit or that state tax deduction for that year. And I see a lot of people leave money on the table because they don't know to just plop it in the 529 and then send it to the school.
Matt, there was one thing written down. I don't know that we hit it. And I think it's a good way to, one of the last points we can hit for this conversation is the most common mistakes, biggest mistakes that you see from service members or federal firefighters.
I went back and forth on this on what I was actually thinking would be the most common mistake. And I think I have two. One from a financial planning perspective. I think it starts when you're in the military and you get out of tech school and you probably get a loan you can't afford. And the bank's in the business of making money and they see your income is pretty steady. And you get used to that. And you're like, yeah, I'm like, I work for the government. Like this is easy. I don't need an emergency fund. And I know a lot of people who live this way and they just don't want to, my paycheck, I'm going to get it, like regardless, I'm in the military. And when you start to build those, I think, bad habits, then you see it on the other side in the federal service. Guys who don't have enough saved. Most Americans can't cover a $300 emergency, and 40% of America isn't invested in the stock market. Well, we've already seen the longest federal government shutdown this year. The military got paid, but that's not always the case. The shutdown in 2018 and 2019, the military did not get paid. I think we've gotten too comfortable with the fact that we've worked for the federal government, whether active duty or, federal service, and that it sometimes breeds bad financial habits. That's my financial planning perspective on bad habits.
What great advice is that? Definitely. And like you said, as of late, it's been a commonplace, and it's probably going to continue, I would say, because we're in such a politically volatile time. this isn't going to be the last shutdown that we see, and having that emergency savings. Because what was the last one? 47 days, something like that. And they bailed us out a couple times, military specifically, active duty military. But that could not always be true. And how are you going to pay your mortgage and your loans and for food and et cetera, et cetera? Man, emergency savings is so important. And it goes quick too. You don't realize how much money you spend until it's not flowing in anymore.
Yeah. And again, what are we doing? Because if we don't have that emergency fund, are we now going to have to take a TSP loan? Are we pulling Roth contributions tax-free so we're not increasing our income? But if you take contributions from your Roth IRA, you don't get to put them back. That's it. So if I take my contributions from 2023, I can't replace them. Again, having those different accounts, well, even if I have a taxable account, I may have some capital gains, but at least, I don't have to withdraw from the TSP. So getting those bad habits, I think is just part of, I don't think it needs to be, but I think it's part of the reality that we see every day. That's the financial planning one. As far as tax, I think too many people wait too long to come to a tax professional. I know that's coming from a tax professional, but if I have to go correct a bunch of returns, like it's going to cost you more money. And if you would have done it up front, getting depreciation correct on a rental, paying state income tax when you didn't need to. I know there's free DIY software, and for most people, if you have a really simple situation, it's plenty fine. I'm not saying that everybody needs a tax professional. That's not what I'm saying. But I think the people who have a more complicated situation tend to wait too long.
That's good. Well, man, to kind of wrap this up, for anybody that, is in that boat where they have a more complicated tax return, they're trying to figure out their no tax on overtime, and they want to reach out to you, what's the best way to do that?
Through my website. So stellarwm.com, STELLARWM.com. Just fill out a contact. You can email me, Matthew@stellarwm.com, or fill out a form online. But those are the best ways to get a hold of me. I'm on a computer a lot, just doing tax returns all day. So I should reply. My goal is always 24 hours. So.
Man, when I first heard that, and this is no disrespect, it reminded me of Stratton and Oakmont from Wolf of Wall Street. It's a strong name, Stellar Wealth Management. Can I real quick ask the scope of what you do handle for those of us, to include me, who don't understand the different acronyms that come after your name and your email signature block? Like, what is the scope of what Stellar Wealth handles? Can they handle tax planning, tax preparing, and financial advising? You know what I mean?
So at this stage, I don't do financial planning because you have to register with the state, and it involves giving investment advice. I do not give investment advice, even though I have the designations to, because my wife's still active duty and we're PCSing. I'm not going to register and deregister with a bunch of states. The enrolled agent is federally recognized, and so I've decided that I'm going to focus on tax. So tax advice, tax planning, tax prep. Like, if you think, hey, I think I'm going to sell my house next year, I want to look at what my capital gains are going to be, right? Do some tax planning in that regard. In addition, it would be representation. So if you get a letter from the IRS and say, hey, we want to look at this tax year, I can communicate with the IRS on your behalf and find some resolution, hopefully where you're not paying, but potentially, figuring out an installment agreement or something like that. But tax focused. For financial planning, for investment advice, you're going to have to go to one of those other designations, like we talked about, a CFP, MQFP, CHFC. I mean, there's so many. I don't know. What's an investment advisor? What's a fiduciary? It gets jumbled and it's very confusing. But I mean, at the end of the day, if you're looking for someone, I think the best thing you can do is ask them how they get paid.
Excellent. And one last thing, man, I just kind of want to give the listeners an action item. We talked about overtime and no tax on overtime. What if they missed it? If I'm working a lot of overtime and it's a confusing year and they just wrote these new laws and they haven't caught up, your employer may have not caught up on how they track that. What do they need to do? Do they need to go print or keep track of every pay stub month to month? Is that the only thing they need to do?
That's the best thing you can do, because people get promoted, people work extra shifts, and the best way to do it is to look every single pay stub for 2025 and see, add it up. How much did I work? That is the best thing you can do to make sure that you don't miss any sort of deduction that you can take.
Cool. I appreciate that. And Chris, that's all I had, brother.
Man, so some great actionable planning points in this episode. Matt, we appreciate you coming on and dropping some knowledge on us. And we're going to try to get this out in a timely manner just because of how applicable it is to firefighters, military, and DoD civilian right now. So
thank you for listening to this episode of the Fire Dog Podcast. If you found value in today's conversation, please take a moment to rate and review the show on your podcast platform of choice. It's one of the best ways to help us reach more firefighters and leaders across the service. This episode was supported by Roll Call Coins, telling the story of fire departments and teams through premium, custom challenge coins. Learn more at rollcallcoins.com. It was also supported by AOS Services, helping fire departments stay mission ready with worldwide firefighting equipment compliance. Find out more at aosservicesinc.com. You can find more episodes at firedog.us, wherever you listen to podcasts, and be sure to follow us on Facebook, Instagram, and LinkedIn at the Firedog Podcast. That is the Fire DAWG Podcast. Sharing this episode with a friend or coworker or someone in the firehouse helps these conversations reach the people who would benefit most. This is Matt Wilson with Chris Boykley and guest Matt Stelmaszek. Till next time, stay safe.